Good day, this is me again, Shaira Canlas of BSND2A. Today, I will be discussing the indirect or implicit cost in healthcare, difference between fixed and variable cost, marginal cost, and average cost. Let's start with private enterprise. It is the ownership of business by private individuals. It includes small-scale, non-employer, and large-scale businesses. Privately owned firms are motivated to earn profit. The question is, how to get the profit or how to compute the profit? Now let's give an example. Fred currently works for a corporate law firm, which he earned $125,000 annual salary. He is considering opening his own legal practice, where he expects to earn $200,000 per year once he gets established. To run his own firm, he hired law clerk for $35,000 per year and rent an office for $50,000 per year. Would Fred's legal practice be profitable? After knowing the problem of Fred, let's help him in calculating the explicit cost. What is the explicit cost? Explicit costs are out-of-pocket costs for a firm, such as payments for wages, rent, materials, etc. In our example, Fred hired law clerk for $35,000 per year and rent an office for $50,000 per year. So our computation will be $50,000, which is the rent per year, plus $35,000, which is the wage for law clerk per year. Our total explicit cost will be $85,000. After calculating the explicit cost, let's now move on with the calculation of revenue. What is revenue? Revenue is an income from selling a product or services. The formula that we will be using is price times quantity sold. In our example, Fred's law firm got 10 clients, wherein he earned $20,000 per client. So, $20,000 per client times 10, which is the quantity of clients, will be equal to $200,000 of revenue. After knowing the revenue, let us now calculate with the accounting profit. Accounting profit is the total revenue minus the explicit cost, wherein, in our example, Fred's revenue is equals to $200,000 and his explicit cost is $85,000. $200,000, which is the revenue of Fred per year, minus $85,000, which is his explicit cost per year, is equals to $115,000 accounting profit. So, what is the implicit cost? Implicit cost are the opportunity cost of resources already owned, such as payment for expansion. In our example, Fred resources that already owned is his work. Fred currently works for a corporate law firm, which he earned $125,000 as annual salary. So, Fred's implicit cost will be $125,000 per year. Let's now proceed to calculating the total cost. The formula that we will be using is explicit cost plus implicit cost is equals to total cost, wherein the explicit cost per year is equals to $85,000 plus the $125,000, which is the implicit cost per year. The total cost will be $210,000. After calculating the total cost, let's now proceed into calculating the economic profit. To get the value of economic profit, the formula that we will be using is total revenue minus total cost is equals to economic profit, wherein, in the example problem of Fred, the total cost is equals to $210,000 and the total revenue is equals to $200,000. So, our computation will be $200,000, which is the total revenue per year, minus $210,000, which is the total cost of Fred per year. Our economic profit will be negative $10,000. So now, after knowing the accounting profit and economic profit of Fred, let's now answer the question. Would Fred's legal practice be profitable? Remember that his accounting profit is equals to $115,000 and his economic profit is equals to negative $10,000. The answer will be yes. Fred's legal practice is still profitable. The problem is, he earned $10,000 less compared to his previous salary. After solving the problem of Fred, let's now proceed to the difference between fixed and variable cost. Fixed costs do not vary depending on the level of production. Examples of fixed costs are rent, insurance, depreciation, salaries, and utilities, etc. For example, in the hospital, fixed costs such as building, salaries, equipment, etc. remain the same regardless of how many patients the hospital receives each year. While variable costs are tied to a company's level of production. Variable costs are direct materials, sales commissions, credit card fees, etc. Example, in an hospital, variable costs include medication and supplies, which change based on the number of the acuity of patients treated. Let us now proceed to marginal cost. Marginal cost is the change in total cost when another unit is produced. Example, the production of one pair of shoes is equals to $30. The total cost for making two pairs of shoes is equals to $40. The computation will be $40, which is the cost for two pairs of shoes, minus $30, which is the cost for one pair of shoes. The marginal cost will be $10. After knowing the marginal cost, let us now proceed to average cost. This will be our last topic for today. Average cost is a total cost divided by the number of goods produced. Example, the production of one pair of shoes is $30. The total cost for making two pairs of shoes is $40. So the computation will be $40, which is the total cost for two pairs, divided by 2, which is the number of pairs produced, is equals to our average cost will be $20. And that will be all. Thank you for listening.